Mr. Tim Harford. Hello, Tim.
Hello.
All right. Well, it's great to finally speak to you. I always feel like I know you because of your work, but I don't. So I'm really excited to be able to have a short time to speak to you. So for those people who don't know you, and that's probably about 4 people listening, do you want to just explain kind of your what you do as your day job and your interest in numbers and statistics?
Sure. So I'm a columnist for the Financial Times, right, for the FT magazine every Saturday. And the column's called The Undercover Economist, which probably tells you a little bit about where I'm coming from. I'm an economist and I write about the economics of everyday life. I've also written a whole bunch of books. The first one was called The Undercover Economist. And the most recent is called How to Make the World Add Up, 10 Rules for Thinking Differently About Numbers. So that's really trying to help people think through all of the bewildering claims that they see all around them every day on social media, in the newspapers, on TV. So that's the writing, but I also do a lot of broadcast work. At the moment, I'm recording a program for Radio 4 called How to Vaccinate the World. That's running every week. We started about 5 weeks ago, so that would be end of November, beginning of December. And we'll just keep running until we've vaccinated the world, I think. So we're just following that rapidly unfolding story. I also present a Radio 4 World Service program called More or Less, which is a bit like the book, How to Make the World Add Up. It's all about numbers and how to think about numbers, how to think clearly about numbers. And I've got an American podcast too called Cautionary Tales. That's where I really kind of have fun. And stories of catastrophe, fiasco, disaster. Some of them are funny, some of them are tragic. And in each case, I'm trying to use ideas from social science to learn lessons. How can we prevent this terrible thing, or sometimes this very funny thing? How can we stop it from happening again?
And just interestingly, out of your last book, what I really found interesting was that each of your chapters is really, I call it common sense when you think about it. But one of the things you talked about was that if something doesn't add, it doesn't make sense to you, go beyond the kind of the hyperbole, the headline, and think beyond it. It was just a simple thing. I mean, it's obvious, but the way you put it, and you give lots of examples of it, it just makes you, the more you can question things and the more you can think of things from a different perspective, it just means that you'll make better decisions yourself, won't it? And you'll be a bit more well-informed.
Yeah, and I think there is a connection here, and we'll get to it, to the way to think about money. Because one of the key messages of How to Make the World Add Up is a lot of it is actually not that complicated, but it is fraught with emotion. A lot of people trying to sell us things, a lot of people trying to persuade us of things, a lot of people trying to pull us into arguments for their own purposes, and very often people think about statistical claims as a kind of weapon in some kind of political battle, some kind of argument. And that's understandable. We're all humans, and politics is everywhere, but it's not very helpful if you're really trying to think clearly, see the truth, and make the right decisions. So one of the things I'm encouraging people to do is to notice their own emotional reaction to claims, and before you mash your finger down on the retweet button, or you're sharing, or you just notice, am I having a reaction to this? Am I thinking this is fake news? Am I in denial? Am I thinking, oh, this proves I was right all along? Is this a zinger I want to sort of throw at the other side? All of those thoughts are, I think, perfectly understandable and perfectly human, but they're not helping you think really calmly and clearly about what's true and what isn't.
And at the end of the day, as I've explored in the thousands of people I've interviewed over 30-odd year career, and latterly in the podcast series, is that essentially there are 2 dominant emotions that are driving everything we do, isn't it? There's a desperate need for safety, and that involves connection and being wanted and accepted and stuff, and also the need for control. So that's fun, that's fulfillment, meaning and stuff. So if we understand right at the root of it, there's those 2 principal causes, then again, we can realize that we're human, we're not perfect, we do make mistakes, and that's okay. It's just navigating it. So look, Tim, I'm fascinated to know kind of what your kind of upbringing was and your introduction to money as such, the whole role of money in life, and what you can remember about that, and how that shaped your early adult beliefs about money.
Sure. Well, I I think I was brought up in a very British way, which is that my parents didn't really talk about money. I think we were, I mean, sort of proper middle class family. My dad worked all his life for the same company, a computer company originally called Boroughs and later called Unisys after a merger. They fitted mainframes for the Metropolitan Police or for banks in the 1970s and 1980s. So it was a good, solid job, reliable job, but not massively well paid. My mother didn't work when I was a child. She was a full-time housewife. She had a nice sideline in being a computer hacker. I mean, she loved taking computers apart and
Really?
taking software apart herself.
All
Yeah, just
right.
for fun, just for fun. But so she was very interested and engaged in that, very smart, but not doing paid work.
Mm.
Uh, so I think we had enough money, but we didn't have a load of money. I remember one year I had set my heart on a Lego space cruiser. This must have been around 1979, 1980, and my dad sitting me down on his knee and saying, "Well, you might not get that. The boiler's broken down and it's expensive to fix, and we'll have to see." Now, I did get it, and I don't know whether it was a shot across the bows to tell me not to be too greedy, or whether they were genuinely worried they might not be able to afford this thing, and possibly my grandparents chipped in instead. But that's a conversation I remember having about money, which was, here's a thing you want, and it's quite expensive, and we've got some money worries, and you might not get it. But at the same time, as I say, I did get it. The money worries obviously weren't that significant, but I never knew how much my father made, for example. Never discussed salary, never discussed his pension or his his savings plans. The other conversation I remember having was I got a national savings account opened, and this older listeners will remember I used to have this kind of these little books, and everything would be written down, how much
That's
money
it.
you had.
Yeah.
Yeah. And I remember him talking me through compound interest, and he said, "I imagine you got compound interest of 10% a year," and I must have been about probably 10, 11. I wasn't that old, but he did the maths for me, and he showed me the maths of compound interest, and actually how quickly 10% interest a year would turn £100 into £300. I was very impressed by this. Obviously, 10% interest rates are a thing of the past, but
Yeah.
the
If
lessons stuck.
only. Yeah.
Yeah, yeah. So there were a few kind of, I think, moments of good common sense that I remember, but it wasn't discussed a lot.
Mm. Now, as you know, childhood does influence a lot of our early adult beliefs, even if we then update and change them, which is something I'm very keen to get people to do. But can you remember messages that are related to sort of money, work, earning, spending? Like, for instance, my mum used to say, well, money doesn't grow on trees, or do you think I'm made of money? So that created in me scarcity, right? It created an anxiety in me that there was never going to be enough, and that we were always going to, like, we were against that security thing. I'm just wondering if there were any subliminal messages, particularly from your hacker mum about money, because clearly, often in those days in the 70s, when you were perhaps one of them was a home carer who had to manage the budget, they could have a different kind of a reaction emotionally to money than perhaps the primary breadwinner, if that was how the family was organized. Just wondered if there were any other messages that you remember hearing.
Yeah, it's a good question, because I think the answer is no. I think I was quite well shielded from the subject, and that, I think, in and of itself is interesting.
Mm.
It was not a thing I thought about very much. It was not a thing I worried about very much. It was a sort of, this is something grown-ups do, and you don't need to concern yourself. And I had pocket money, and my parents discussed how much pocket money I would have. Later, I had a paper round, and so it was sort of this sort of discussion of budgeting from in this little toy world that I inhabited as a child. How long would I have to save up to pay for something? But no, I don't remember a lot of that, the kind of messaging you discuss. I do remember being struck by the fact that my wife always says, or her dad always used to say, every day's a holiday. You can't take it with you. He had this attitude. And by the way, it was perfectly sensible with money, had a good pension, retired with a very nice, comfortably sized house in the Lake District. There was no, he wasn't a spendthrift kind of person, but he always had that message of that, you could be too frugal. You could save too much, and you could regret that, and you needed to live a little bit and enjoy that. So I was struck by the fact that I was getting these messages as an adult from my wife, remembering being told that as a child. But I was thinking, I don't remember being given these little proverbs.
Now, interestingly, the first bit of agency that children get often is their allowance, pocket money, call it what you will, whether they do chores for it or they get it just given to them. Did you carefully sort of save it and then build up for something? Did you spend it as soon as you got it, or did you do somewhere in between?
I used to save it up.
Really?
I definitely used to save it up. Yeah, that's what
marshmallow experiment. You deferred gratification. The marshmallow experiment. Yeah.
I did defer gratification, or at least that's how I remember things. Although one thing I do remember is we used to go swimming every week. I was quite a serious swimmer by the standards of the 1980s, not by today's standards. I mean, these kids I know who swim, but like they're up at 4 o'clock every morning.
Yeah.
I used to go to swim club. I used to be quite a keen swimmer.
Yeah, you're keen.
And I used to get 20 pence from which was the locker money. I used to be able to keep the locker money after I got it back from the locker. I used to be able to put it in the vending machine and buy a chocolate bar. And a chocolate bar back then was about 15 pence, 18 pence. So it was kind of the perfect price. And I did spend that. I could have kept it. I could have saved it. So that's an interesting sort of little insight into the kind of mental bracketing. I think very occasionally, if I had something I was really desperate to buy, I'd save up the 20 pences as well. But mentally, I felt, no, this is you've exercised, you're tired out, there's sweets right there, you've got the money, and that money's for spending on sweets. And the money you get every week as pocket money, that's not for spending on sweets, that's for saving up for toys and books.
But you're illustrating there something which we know from all the research shows, that people think differently about the money based on size, the amount. They think differently, and also where it's come from. So the source of the money and the relative size meets whether it's buying a house or whether it's just buying a pair of shoes versus you've inherited it or you've earned it. That's interesting. So I must just be honest here and say that my pound pocket money I used to get in 1980, I used to go straight over to the off license, get a fizzy drink and 3 chocolate bars, eat and drink it all till I felt ill. I don't know why, but I did that for 2 years, and then I thought, this is not working for me because I don't enjoy it and I've got no money. So there we go. That's probably a precursor. If we'd have done the marshmallow study, and if anyone wants to know about that, the marshmallow study was done many, many years ago, where they put children in a room and they said, here's the marshmallows. If you don't touch one, you can have another one, but if you eat one, there's no more. And they showed that the ones that could hold out the longest and not have immediate marshmallow and wait for the second one, they did better in every mode in life. But there's still chance for us all. So, okay.
I should say, on the subject of the marshmallow experiment, two quick things. One is Walter Mischel, who is the psychologist who conducted that study. One of his students is Maria Konnikova. And Maria is a wonderful writer about ideas in psychology. She wrote a book about confidence tricks, and her latest book is about poker. It's called The Biggest Bluff, and it's just a great book about so she's a professional psychologist, professional writer who takes up poker because she thinks it'll be interesting, and it's such a roller coaster ride. It's a terrific book about psychology and about the emotional component of poker, which I think is not unrelated to the emotional component of making other decisions. The other thing is just, I know this is not a political podcast, but I just saw this morning on Twitter somebody speculate on how Boris Johnson would do on the marshmallow test, and he just said, just imagine the psychologist explaining the rules and then looking up, and Boris Johnson's already cramming the marshmallow into. I just thought, yeah, there's something very true about that.
Well,
Anyway,
yeah,
sorry.
as I say, I don't think if he was younger, that I'd want him to be taking my daughters out. But there we go. Let's put that to one side. So, yeah, interesting. So you mentioned about you had a paper round. So this thing is, so your first agency was the pocket money. Then you moved into having a paper round, or
Yeah.
like anyone did. How did you sort of do that transition from being reliant wholly on your parent to then eventually moving into the world of work? And what role did that kind of childhood working for money play in that?
Well, it's a slow and steady thing, isn't it? The paper round, by the way, I guess it's not so much of a job these days. With the way that we get our news from the internet, but paper round was a fantastic job because you got exercise every morning, and you also got to read all these different perspectives, because you'd read the newspaper, at least the front pages and the back pages. You'd read the newspapers as you were going around the estate where I lived, and you'd realize, oh, these newspapers have got very, very different takes on the world. It was a really great education. That's a separate thing. So yeah, I mean, having that sort of job was a great transition because you had to take responsibility for what you were doing. It dramatically increased the amount of money I had available. I think I was paid £1.20 a day. Sort of been in the late 80s, early 90s. £1.20 a day, and it was probably for about half an hour, 40 minutes work. So then you're sort of talking a £5 a week, and my pocket money was probably £1 a week at the time. So there's a huge increase in how much money I had in my piggy bank. But obviously a £5 a week, even in 1990, is not a lot of money. So for the big stuff, you're still dependent on your parents. But that was a good transition. And I think it was nice that there was a gradual kind of move away. So when I went to college, my parents was responsible for my maintenance grant. At the time, this was the college fees were paid, but your living expenses weren't unless your family had a low income. So my parents gave me a monthly allowance and told me to sort of figure it all out. But of course, if I got into but there'd be little things like, I think they gave me a special kind of phone card so I could make phone calls.
Oh, phone cards! You're going back a bit there, yeah.
Yeah, but the bill would be sent to them.
Oh, okay.
So, and I had a credit card for emergencies that I didn't use, but I did have it.
You had really?
I was given a credit card with, I think, a £250 limit. So not going to break the bank.
Yeah.
But I think there was a moment where my little sister, I had younger sisters, and one of them was quite a lot younger, and she came to see me where I was going to university, and my dad said, "Oh, you can buy her something with the credit card, that sort of thing." But I hardly ever used it, but it's funny the stumbles you can make over money. One moment I really remember, I was probably 24, 25, finished my master's degree. I'd worked for a year already as an economics lecturer, and I moved to London, got a job in a management consulting firm. And almost the first thing that happened is I got an income tax bill for, I forget, about £3,000. I didn't have £3,000, and I didn't really expect to receive this income tax bill. And I just wasn't ready for it. And I had some money in a savings account, but it was a 90-day notice period or a 30-day notice period, I forget. So I remember calling my dad and saying, "What am I going to do?" And he said, I'll give you that money and you can pay me back. Now that's a very fortunate position to be in. I mean, I realize I'm only borrowing a few £1,000s and I'm only borrowing it for a few weeks. But I could really have stumbled there. And it was over something that you would think was a simple thing. But it's that first contact with the tax system and the bureaucracy and realizing, oh, hang on a minute. I didn't see this coming, didn't see any of this coming. And this is somebody with, I've been studying as an economist for 6 years by then and had a perfectly well-paid job. But adulthood still trips you over, doesn't it?
Yeah, and interestingly, in all my work and research over the years, I found that there is a correlation between people who are numerate and those who are better with their money. But as we know, there's the emotional component. So it doesn't necessarily follow. So if you're listening to this and you find that numbers and statistics is not your strong points, or you didn't like maths at school, it doesn't necessarily follow. It just means you have to be a bit more cautious. So I'm interested to know, to what extent do you think your economics training equipped you to make smart money decisions, or at least intentional and sensible ones that minimize downsides and maximized your well-being and happiness?
I think economics helps a lot, to be honest. I mean, one thing it does is it makes it easier for you to find a job. It's quite a well-paid degree, so that it's a lot easier to look sensible about money if you've got some money. I mean, that's the first thing, and I always need to recognize that that privilege. But there's another thing that economics teaches you is it will tell you the optimal way to approach a lot of financial calculations. And it will also, through behavioral economics, tell you a lot of the mistakes that people make. And I think that dual approach is very powerful, because you simultaneously have a benchmark. Like, if I was Spock from Star Trek, this is what I would be doing. At the same time, oh, I recognize this mistake that I'm making while I'm making it. This is a very common kind of bias that a lot of people have in their behavior, and I can see it in my own behavior. So those things I think are very helpful. A couple of things that in particular I think have helped me. I've been perfectly comfortable investing in the stock market. I've also not tried to be too clever about investing in the stock market. I tend to be an index fund kind of person, because economics teaches us that you can't beat the market. Now,
nil-sum game, isn't it?
Yeah. I mean, now I know that some people can beat the market, some people do beat the market, and the efficient markets hypothesis that comes out of economics isn't right, but it's not very far wrong either. And I think treating it as approximately right and being skeptical about your own ability, or the ability of high-paid advisors to beat the market, I think is a good start. But you also learn about something called the equity risk premium. It's changed a bit over the last few years, but when I was a student, it was a big puzzle. And the puzzle was, how come people make so much money just putting money in the stock market and leaving it there? They seem to earn this extraordinary rate of return relative to other assets. And it was called the equity risk premium puzzle. People didn't understand it. And it's sort of gone away a bit because stock markets surged and have stayed pretty high for a long time. But that taught me, there's money lying around if you've got the confidence to put a bit into the stock market. And a third thing is just an awareness that there are a lot of people trying to sell you insurance for small things that you don't need to have insured. So when you show up, remember when we used to have those things called holidays, where you used to fly places? And, I know.
Distant past,
Yeah, well, maybe the distant future as well. Who knows? But when you you go and you rent a car, they will try to sell you kind of insurance on the insurance. So legally speaking, you have to have insurance, but then they'll say, well, but if you crash, you've got an excess, and the excess will be really scary. So we'll sell you insurance for the little bit of insurance that you don't have. I remember I bought a fax machine for one of my first jobs, and they were trying to sell me insurance for the fax machine. And I was saying, well, why would you sell me a dodgy fax machine? Why would you?
But it's like mobile phones.
Are you telling me this thing is going to break down? But same thing with mobile phones. You're going to mention. I mean, there are lots and lots of things, and there's a very clear behavioral economics account of this. That we have a disproportionate anxiety about any individual risk that you could possibly pin down. Makes it, the moment you highlight it, people go, "Oh, don't fancy that." Whereas, of course, if you take a step back, you say, "Well, the risks that I get a 2.1% salary increase instead of a 2.2% salary increase. The risk that my stock market portfolio falls 1% today rather than rises 1% today. I mean, these are much bigger risks than your mobile phone needs replacing for most people. And for most people, they shouldn't be buying insurance for these little individual risks. They're going to be massively overpriced. But to take that risk, you need to sort of step back and be a bit zen about it, and to know that occasionally you'll have to reach into your pocket and pay to replace something that you could have insured. And you'll have to be fine with that, as just that's part of the mix.
Well, it's interesting because I teach the 8 money milestones, which is just a framework for understanding money. And milestone 6 is have the right human insurances. So the biggest single risk that working people have is an interruption to their income through illness, disability, or redundancy. Now, redundancy is something you have to protect through being relevant, skills, adaptability, being well mentally and physically, etc. But income protection insurance, which is, we will take over paying you your income if you cannot work for a prolonged period, is, to me, it's the same as having oxygen and food and water. But it's something that people can't understand. And it's quite expensive relatively. But even now, at 51 years of age, I pay £100 a month to insure £50,000 of income, even though I've got assets and I don't really need it, because for me, that's a risk I'd like to insure against. I don't need it, but I think it's a good payoff because there's a good chance I've seen people where that's happened. But younger people, where their human capital, their ability to earn, and their ability, therefore, to pay off debts and build, so they just don't seem to see that, and it's a very underinsured area because people compartmentalize it and don't think it's going to happen to them. Whereas the mobile phone is something they're seeing all day and they're connected to it, and they don't like the idea of losing their mobile phone. But their income, who cares?
My income's insured. I forget the exact details, but against illness and those sorts of interruptions. And it is, as you say, really, really expensive. But I think,
but that tells you something.
It tells you that actually these are very large sums of money at stake, and it's not a trivial risk. And this is, it's a competitive market this insurance is provided in. So if it's expensive, then it's expensive because it's valuable. Whereas, incidentally, if someone's trying to sell you mobile phone insurance, it's usually the person who's also selling you the mobile phone. So you're not in a competitive market there. You're a captive audience. So I don't insure my mobile phone. I don't insure fax machines. I don't insure
fax
hi-fis or any back in the day. Don't insure any of that. But like you, I do insure against critical illness and loss of income.
Yeah, absolutely. So I think that's a really interesting one. But I'm interested to know if you're prepared to share it, because I share all my blow-ups in the past that I've ever had, because I think as long as we can learn from it and we can be honest, I'm just wondering if there's anything you look back on, a financial decision that you realize with hindsight was not a good one, and what you learned from that.
Well, I am very struck by my decision-making during the early weeks of the pandemic. Trying to figure out, you remember sort of suddenly this realization the lockdowns are coming, the stock market kind of crashed and then it bounced back quite quickly. And I remember watching my own decision-making at the time and trying to figure out, and there were a couple of different things going on. There was viewing my portfolio. So I had a bunch of shares in ISAs. Viewing that and trying to figure out, have I missed the window to sell? If I sell now, am I going to sell at the bottom? All of this. But there's a separate thing, which is some of my income was interrupted. So I was about to publish a book. The book was going to sell into the middle of this lockdown. No one wanted to talk about books. All the book festivals had just closed down. So I was thinking, well, that's going to be bad. And I'm wondering what the likely future for my job was. And I also make money giving talks. Well, that wasn't happening.
Yeah, same here.
So all those talks were being cancelled. So I was sort of sitting there simultaneously thinking about what the market itself was doing, but also trying to think about how that tied into my, my wider kind of earning power. I don't think I got it right. I don't think I got it dramatically wrong either. I think I should have sold earlier because I had privileged access, not confidential access, but I was talking to the epidemiologists early on because of my job, and they were telling me what was coming, and I was believing them, and yet not acting. I wasn't able to turn that into action. And I felt I could have been a month ahead of most people, and I was 3 days ahead of most people. And so I sold too late. But after I'd sold, and I was happy with the decision, basically what I said to myself was, okay, you've sold and you've lost 10%. If you'd sold a month earlier, you could have got 10% more for what you sold. But you've sold because now you need this cash cushion. You've got a tax bill coming that you thought you were going to be paying. You had these various sort of sources of income that were coming in, were firmly in the diary, all contracted. They're all cancelled. So you need the money to pay the tax bill. You've got the money, it's in the ISA, but you're going to have to sell by the time the tax bill comes due. So when do you sell? And so I sold, and I have to say, I probably sold pretty much at the bottom. But I said to myself, I'm happy with the decision. I can't guess where the market's going to go.
But it's only the bottom, Tim, after the event. It's not the bottom at the time. Absolutely. You're looking at the bottom. Yeah,
absolutely. And I then said to myself, what you're going to do now is you're going to drip this back into the market bit by bit. You're going to set up a regular debit, and slowly the money is going to come out of this. I've got a mortgage offset account. So that's earning perfectly reasonable net rate of return, offsetting a mortgage. Slowly but surely, that's going to go back into your ISA, and you're not going to beat yourself up about it. And so I think I made, with hindsight, not the best decision, but I think I was reasonably happy with my decision-making process. So I felt that I'd given up some money for some peace of mind, and I'd made a strategy for what I was going to do afterwards, and it's been fine.
There's a well-known economist called, is his name Hausman? Is it Hausman? I'm trying to think.
Ricardo Hausman.
Ricardo Hausman, yeah. Who's a very alternative kind of writer. I got thinking the other day, with stock markets being quite high, he makes the point very clear that when stock markets are at historic highs, even if they can still break new highs, the expected returns going forward over the next 10, 15 years, whatever measure you use to determine historic highs, means the expected return going forward has got to be lower. And the downside risk of you losing money in any short 2, 3, 4 year period is much higher. And I got thinking, my pension pot is pretty, it's getting near to the lifetime allowance, fortunately. And I thought to myself, well, why have I got equity risk in this anymore? I don't need it. I just chopped out all of it into index-linked gilts. Not because I don't want growth and had to reorganize stuff, but just because I was going to be penalized for tax purposes by taking all that risk. And I'm in the business, and I've been around for a long time, and I've been counseling clients, and I'd let that equity risk build up in the wrong pot. So it's not so much, I think the thing is we compartmentalize our money, don't we? And we are in danger sometimes of not looking at the whole and then realizing where the true risks are. So for me, there's a risk of having growth assets with upside in my pension pot. It's not the downside risk because I'm not going to draw it for many years. But for me, that crept up on me when I realized that actually, if there's more downside of losing money and the upside means I get taxed, that's not a good thing. So even the best of us can suddenly float into a situation where we need to reappraise our scenario, not based on a knee-jerk reaction, but based on the fact that the environment has changed and the risks and rewards are changing. And they're changing all the time, aren't they?
Yeah, they are. And you're absolutely right. I mean, if I were to come up to you and say, look, I'll offer you a bet, heads or tails, heads, you win £200,000 and the government's going to tax 60% of it. Tails, you lose £200,000. And you'd go, well, that doesn't sound very good. That sounds like a really, really lousy deal. But if you're sitting there with an equity stuffed portfolio and you're at your lifetime pension limit, that's basically, I mean, I don't know what the tax rate is, but it seems pretty high. That's basically the deal you've accidentally signed up for. So yeah, you're right. You need to keep reevaluating, and it is going back to that decision that I made with the 20 pence after swimming, where I would say, well, this is the sweet money, and it's different from the pocket money. That's doesn't make any sense, but it's very human. We're always like that. You could. It's easy to sort of get really. You might have £5,000 in an ISA and £100,000 in a pension, and you're obsessing about the £5,000 in the ISA, whereas in fact all the risk is in the pension. It's very easy to lose track of where the risk really is, and you do need to sort of take a step back and say, what's the overall position, and does it make sense?
I'm interested to touch on, just you mentioned about your wife had a different kind of upbringing and money messaging and beliefs and scripts and stuff. She was growing up. Sounds like her parents were a bit more sort of enjoy the moment, enjoy the money. How have you as a couple managed to navigate the inevitable, kind of tensions that happened in any relationship between decisions and who earns what, and how you make big decisions versus small decisions, and who does the day-to-day and who does the macro, and you know what I mean? It's just that how have you managed to navigate that such that you make good decisions and minimize conflict and disagreement?
I think we've been very lucky because we haven't had a lot of conflicts, and the various points at which things could have been difficult, I think we've had some of the painful decisions taken away from us. So, for example, when we first started dating, she owned her own home and I didn't, and we just agreed I would pay her rent, and that's the fair way to do it. And we met in the office, so we were both sort of earning similar amounts of money doing similar jobs. That makes life easy. So for a while it would just be you'd split bills, or you'd take it in turns, and she owns the house and I'm paying the rent, and then you just gradually transition to, well, we've got a joint account and let's put more money in the joint account. When we got married, we just agreed I was going to pay her. I had some savings. I'd just pay her a lump sum. And actually, I forget exactly how we just sort of came up with a deal that it just felt fair, that
you sort of equalize the situation.
Yeah, we owned the house together and it was fine. And it was fair, and no one was taking advantage of anyone else. And then about the same time that we got married, I got a very tempting job in Washington, DC. She wanted us to have a baby, and she got pregnant fairly quickly. And so we had the situation where we both wanted to quit our jobs. She was pregnant. I had a job offer in the States. So and she was then not legally allowed to work in the States. So then suddenly we moved to the situation where I'm the breadwinner. She's at home with the baby, and there's nothing to do about it. It's no that's not a choice anyone's made. That's just the American immigration system, and it was fine. So we didn't have to have any difficult conversations, because it was obvious that we needed to open a new bank account in America. It needed to be a joint account. I'd be contributing all the money, and that was just the way it was, and that's fine. And so whenever we've had these big sort of life-changing decisions, or sort of important moments in life, we've always been able to just talk about it, and it's been absolutely fine. I don't think we've ever really had any struggles. And there's certain things that we agree that she thinks about. So, for example, we have almost for historical accidental reasons, that house that she owned, we never sold, so we rent that out. So she manages that. I deal with the stock market stuff because I've been thinking about it for the last 30 years. So, and that's just fine. And we keep each other in as to who's doing what.
Yeah. And I was just interested to know, bear in mind you've done so much research, Tim, and you've met so many interesting people. What would be your sort of top tips for anyone who's listening to this podcast to think about? Let's say that they haven't saved as much as they should have done, or they spent and splurged more than they should have done, or they didn't do as well at maths at school, or they feel there's some sort of issue they've got. What would be your best advice to someone about how they can have a better relationship with money, such that they enjoy life more and worry less? What would be your top tips?
And there's so many really good books about this, and everybody is coming from it from a very different angle. You've got the kind of the financial independence, retire early crowd. You've got the Motley Fool crowd, who are all about, I'll tell you how to invest. The people who are, I'll tell you how to save money. So I would hesitate to give any particular piece of advice. There's even Pollack, who's got the financial advice on the back of a postcard, which is more designed for Americans, but it's pretty good. So there are loads of great resources out there, and everyone is going to need something different at a different time. But the one thing that I would say is, just as I say in the first chapter of my book, just observe your own emotional reaction. If think about your own feelings, because the feelings that you have about money are going to guide the kinds of decisions you make. So where are you just too keen, too greedy, too eager to get involved and do something or spend something? Where are you overconfident? Where are you scared? What sort of corners of the financial rug do you not dare to lift up and look at what's there? What are the conversations you're keen to have? What are the conversations you're keen to avoid? Just notice all of that. And once you've noticed it, I think you're in a better position to say to yourself, okay, this is the kind of advice I need, or these are the kind of skills I need to build, or this is the kind of book I need to read. But those emotional reactions, they're very easy to have and to not even realize you're having them. So notice them.
And I think you make a good point there to end on, is that being aware of stuff is the key to making a difference. As Carol Dweck, who came up with a mindset book, Growth versus Fixed, just being aware of it makes you more of a growth mindset person. So being aware is good. And secondly, as you say, put some time in, just a little bit of time into brushing up your knowledge, your experience, talking to other people, just find what works for you. So that's a great one. Look, Tim, your website, can you just give us a shout out on your website so people know where to get you when they want to book you for those talks?
Yeah, so the website is timharford.com. So it's just my name. Just to say, it's not Hartford, it's Harford. timharford.com.
Yeah, absolutely. Great stuff. All right, Tim, well, look, thank you very much for your time. It's been great having you on the show, and I look forward to reading your next book when it comes out and seeing you on stage somewhere.
Terrific. Thanks so much.
Thanks for listening. If you want more money insights, do visit my website at jason-butler.com or connect with me on Twitter or Instagram at JB the Wealthman. See you next time.